What's happening, guys? Today I want to share something a bit different. This is an investment strategy that I've been practicing for about the past 2 years. As you know, I like to test things a lot before sharing with you, but I'm at the stage where I feel confident in sharing with you what exactly this is about so that maybe you can take advantage of it as well. So the first thing I want to do is actually show you the results of using this investment strategy. You can see them up here, and I'll probably make it full screen here, but I've just blanked out which specific companies they are and the quantity of shares. The main thing is this area here. You can see the returns that have occurred over the period of this investment. Now, some of these have been held for about 15 months. Some of these have been held for as short as 3 months. In fact, the lowest return there is the newest allocation at 17.7%, and the longest allocation, or the oldest allocation, is at 131%. That's how much the value of these investments has grown. So you can see we have an overall growth of 63%. And so within this video, I want to show you how you could potentially make that same type of return in 6 steps. Now, before we move on, I do have to say this is not financial advice. I am not a financial advisor, and you should always consult with yours before making investment and financial decisions. So basically what this is all based on is value investing. It is the opposite of index investing, like investing in the S&P 500 or the FTSE 100. This is totally different to investing in an index of hundreds, if not thousands of companies. This is choosing specific companies and only investing in those. Now, a lot of the arguments against this investing strategy is the lack of diversification. But to me, this investment strategy of choosing specific companies makes much more sense than index investing. Just personally, my feeling when investing in an index fund, it feels a little more like gambling to me personally, because I don't know all of the institutions and companies included in where I'm putting my money. I can't track them. I don't know what they're doing. I don't know who the managers are. But with value investing, you're looking at all those things. And it's a big shift from investing in stocks to looking to own a piece of a company that you love. That's the big difference here, and you're going to see how that plays out. Now, when I began doing this, at first I thought, okay, maybe I'm just getting lucky with the companies I'm picking. But as I did it over time with more and more different types of companies, I started to notice there's definitely something here, and that's why I want to share it with you. So here's how it goes. Step number 1 is to build a list of companies. And the core principle here is I want you to look for companies you wish you owned. And through this process, if they show potential, you could become a part owner of that company. Now, there are a couple of requirements you want to think about when you're thinking of companies you love or companies you use often or that could be high potential. You really want to keep these things in mind. These are requirements for the companies you're choosing and putting on your list of, say, 10 to 20 companies. Number 1, it must be a well-established, long-standing company. This approach to investing does not work with small startups, etc. It's got to be a bigger company. 2, you must either like the company, use the company, or at least know exactly what that company does. Or at least you're familiar with the industry and willing to get to know exactly what the company does. Number 3, important. The company is more than likely to be around in 20 years. So for example, Amazon. I'm quite confident that Amazon's going to be around in 20 years. 4, a newer one on the list, the company is or has implemented strategies to make it corona proof. Now, this can also be a situation where that industry, you wouldn't see that as corona proof, but the bigger companies are starting to take more market share because they're losing their small competitors due to this current problem. That's also starting to emerge where those big players in the non-corona proof areas are growing at a much faster rate now. They're taking even more market share, and perhaps after this are really going to dominate the market and see big growth because they've lost their smaller competitors. They've been able to survive because they have more cash. So again, either it's corona proof or has strategies for that, or it's one of those bigger players who's surviving this and is going to thrive in the aftermath. 5, If you can't see yourself invested in it for 10 years, do not invest in it. And 6, the company strongly promotes clicking the like button. Now, as you put this together, I find Yahoo Finance to be a great place to get to know companies better, as well as their financials and just news on that company. You can use Yahoo Finance. It's absolutely free to sign up for. You can see it here on screen. And what it also allows you to do is make short lists. So you can see here, you can actually have day trading lists. You can have long watch lists, which is specific to what we're doing. We're looking at very long positions, value investing. So you can actually make short lists here. So you're able to track the companies you're interested in. And you're going to see why that's important in a moment. I also recommend making Yahoo Finance your home screen if you don't have one already. Just that way you're going to stay on top of this and just keep it top of mind for the cash that you do want to invest. Step number 2 is to vet the company. Firstly here, model, meaning, and morals. The first thing is, what exactly is the business model of this company? How do they actually make money? And I'll give you an example of this. I'm following a ticker called ATHM, which is Auto Home, and they have a website for automobiles in China. And a very big portion of their income comes from advertising. That is, other car manufacturers advertising on their website. You want to know, how are they actually making money? The layman might think they sell automobiles. So you need to know exactly how that company is making their money. The second question to ask here is what they do meaningful and valuable, and will it continue to be so in the future? A bad example here would be newspapers. Really valuable and meaningful a while ago, but we've seen as the internet's picked up, tech has picked up, newspaper sales have gone down. And the third question you want to ask here is, are you aligned with this company? You want to believe in what they're doing. You think it's meaningful. I'll give you an example. One of the companies I believe in is AMD, and the reason I believe in them is they're offering almost better performing products at a way lower price, making them available to consumers, and that's their positioning. Now that's going to hit them on short-term profits, but I believe it's a good business model. I believe in what they're doing, rather than a company that's charging way too much for a product that doesn't seem to be improving. 2, management. Who are the managers of this business? Now, something you can use here is LinkedIn. And so you can see LinkedIn on screen here. This is Micron Technology, stock ticker MU. And so they are in semiconductors. They provide a lot of equipment to AI companies, very involved in that sector, which I believe is going to grow over time. Also in electric automobile manufacturing, stuff like that, really cutting edge stuff. They have a good deal with NVIDIA as well. But here, what you can do is figure out who works at this company, and we're looking specifically for management. So you can see as an example here that this is the president and CEO of Micron. And so this is Sanjay Mehrotra, and down here what we can see is his experience, and you want to be looking at the managers of the company that you want to invest in. And the reason you want to do this is you want to see how long have they been with the company, what's their past experience, and what were the successes of those companies, especially for your top line individuals, your CEOs, founders, MDs, very important. So here we can see that he was actually the co-founder and president and CEO of SanDisk, which I think every person watching this will know. So this is a really good sign. He's someone who works at a company for a very long time. You can see here 27 years, and we know this company did well. You can see here also Western Digital for a short time, Cavium Inc. as well over here for a long duration, and now at Micron Technology. Now he's already been there 3 years, 8 months, which is quite good. What you don't want to see here is that a company is chopping and changing with management all the time, because the new manager or CEO, they have to now learn everything, and then the company gets going. So when you have chopping and changing of the leaders, almost nothing gets done. So you want longer standing leadership if possible. Another big thing you want to look for is that the founders of the company are still with the company. It's not an absolute requirement, but definitely a benefit, because they're going to keep pushing their idea forward. So look more into who's leading that company, and for any red flags and problems there, or a lot of chopping and changing of management. Number 3 is Moat. Now Moat is like a moat around a castle. It's something that protects the castle. And in the same way, certain abilities, skills, it could even be branding, can protect a company from competitors. They have something that's very hard to replicate, and you want to find that with companies you look at. One example would be Amazon here. They have such huge scale and such intense fulfillment knowledge, it's very, very difficult for people to compete with them, not to mention their brand. Everyone buys things on Amazon now. Very difficult to overthrow the branding and the power of the brand they've built. Now, for other companies, what you can do is go over to their website, as you can see here, and they're going to have an investors section somewhere on this website. So you can see it over here on Micron, for example, and this is going to lay out a lot of press releases and their letters to investors, etc. These areas are often going to allow you to look more into the technical nature of the business and where their advantages lie. It could be deals with certain companies which now competitors cannot get, and that gives them a huge amount of demand which other competitors cannot use. For example, here we can see world's fastest discrete graphics memory from Micron powers NVIDIA's breakthrough gaming speeds. And NVIDIA obviously also doing very well currently, but partnerships like this, particularly exclusive partnerships, say they get all their semiconductor type stuff from Micron, that's going to be a huge advantage for this company. That's why sometimes you'll see in the news things like, oh, this company partnered with this company and the stock price goes through the roof. It's because investors are thinking, wow, that's an excellent exclusive. They're going to get all the demand from that area. But you want to be looking at your company's moat. Do they have particular skills, deals, connections, or branding that's very difficult for others to compete with? Number 4, margin of safety. One of the most important here. This is actually where we figure out if this company is overpriced or underpriced. Is it actually a good buy? Now, every publicly listed company has a stock ticker like these ones here. And so next to that ticker, you're often going to see a price. That's the stock price today. But that does not actually represent the value of a company, its underlying value. Very emotionally driven. It's driven by world events. Press release comes out, that goes up or down. We see that all the time. But how can we work out the actual value of the company? That's going to give us reference for the price. If we don't know the actual value, we don't know if that price is expensive or cheap. And of course, we want to buy companies when they're cheap. Now, one of the best ways to estimate the value of a company is by discounting future cash flows and similar methods to that. Now, I've got 2 ways of doing it. One is a really in-depth way with actual future cash flows, and the other is a shorter hand way, which I'm going to demonstrate to you today. But I'm going to have 2 videos linked below to 2 guys who can explain this better than me, but this is going to give you a very good idea of how to calculate this so you can go look at your potential investments. And really what this is in a nutshell is you're going to find a whole lot of publicly available numbers from Yahoo Finance, MSN Money on the company you're looking at. You're going to plug those into a formula, which is then going to calculate the real value of that company for you. That's often called the intrinsic value or even the fair value. Intrinsic, fair, or real value all mean the same thing. It's the actual value based on the numbers that we have. It's imprecise. It's not 100% perfect, but it's a very good ballpark which you can then make decisions on and compare to the price. But we're going to get more into this. So on screen here, you can see the worksheet I put together for this. You can download this for free below. I'm going to have a link in the description so you can use it. But this just showcases MU as an example. That's Micron, the company we touched on. And what we got to is a margin of safety price of 45.68, as you can see. And this will become more important later when you understand how this works. But if you are interested in MU, you can come back to this part and you'll understand why that's so key. Now, we're going to use the example of AMD, which is quite a well-known semiconductor company. That's what we're going to base this on, so you can see me input everything and exactly how this works. But to give you a quick overview, earnings per share. Now, anytime this is orange or yellow, these are numbers you put in. The blue numbers are things you choose. They're actually from, what you're comfortable with. And then the green, this is going to show us what's expected to happen in the future. And when we discount that, what we want to buy at today in order to achieve our returns. So to break it down in a little more detail, earnings per share, we can get this online. It's publicly available data for every publicly traded company. So we get that for the company and drop it in here. We do the same with the growth rate, and I'm going to show you exactly how to get these. Your minimum rate of return, this is your choice. So for me, I want to at least make 15% on my money a year. Now, within reason, you can choose this for you. Some choose 8%, 10%, 12%, up to you. Margin of safety. This will be explained further in a bit, but 50% is my margin of safety. For any errors we make here or deviations in growth from past or current growth rates, this is not 100%. So what we do in order to really create a margin of error is we create a margin of safety. So whatever price we actually discount to here, whatever price we would want to buy it at to achieve our return, we're going to reduce that by our margin of safety. And then that's what we look to buy the stock at. So we're just giving ourselves a big buffer. Mine is 50%, as you can see here. I'm not going to buy at 91. I'm going to look to buy at about 45 rather, just to make sure this is an excellent buy. So your margin of safety could be 25%, 40%, or 50%. Price earnings ratio, also, we can get this online, and I'll show you how to do that. One default to this is 2 times the growth rate. So we literally taking the growth rate we get online and doubling it, but we're also putting in our 5-year average PE ratio, and I'll show you how to get that. Whichever of these numbers is lowest, this worksheet is going to take and use in the formula. So let me explain the formula and how it works once you've put this in. Essentially how this works is the worksheet is going to take our earnings per share right now, which we know, and that is obviously year 1 of growth. But our earnings per share, so how much you're earning per share, that's going to grow by 30%. That's the growth rate. That's what it's been for 5 years in this case. That's what we expect it to continue to be. So that is then going to grow our earnings per share by that amount each year. So you can see 30% jump. Then from here, 30% jump, and so on until we get to year 10, where we have an earnings per share of 25.45. Now at this point, we actually want to know in year 10, that's our earnings per share, but what's the stock price likely to be when the earnings per share is that? How do we get to this number? And what the worksheet does then is we are going to take our PE ratio, our price to earnings ratio. So we know what the earnings per share is, but what's the price going to be? And of course, that's why we use the PE ratio to find that. We take the lower of these two. Well, the tool will do it for you. It's chosen 15.5, of course. And what it's going to do is multiply the earnings per share by 15.5. And that is how we get to the stock price in 10 years' time. At this point, we want to know, what do we have to buy it at today if we want to have 15% returns all the way up to that price? Well, what we do is we take this number, or the worksheet does, and it's going to discount by your minimum rate of return. So this minus 15% is this, and then from there to there, all the way each year reducing by 15%, and we get to today. Essentially, if all these facts hold true, if you buy it at this price today, you should achieve a 15% return each year. However, remember, there is margin for error in all of this. And with all investments, that's part of it. It does have risk. And so we apply a margin of safety to this price. In this case, 50%. So although we're pretty confident on this, we're actually going to half that amount. And that is the price that we're going to look to actually buy the stock. That is our margin of safety price. And that is what we're looking for today based on the intrinsic value of this stock. So this number here actually tells you more about the intrinsic value, the real value, this 91.37. Again, that's not the stock price, but that's what the company's actually worth based on the numbers in our calculation here. So you're looking to obviously find this company when it's less than its real value, and what would be really good is if it's half its real value. So we are going to use the example of AMD to actually do this now. I'm going to show you where to get these numbers. So first one we need is the EPS, the earnings per share. Here you want to come over to Yahoo Finance, and I really recommend this site. As before, you can have your cool watch lists here to actually watch those numbers for when you actually hit your margin of safety. So at the top here, we're actually just going to input AMD. We're trying to find that stock. And then you can see it autofills here, and we're just going to click on this. Now here we can see AMD, and we can see it's currently trading at about $92 a share. But what we're looking for is right over here, EPS TTM. That is our earnings per share trailing 12 months. And so this is the number we're actually going to input on our sheet, 0.74. So you want to do this for whatever company you're looking at. Search at Yahoo Finance, find your EPS, drop it in on the sheet. So we drop that in here. Now we also need the company's expected growth rate. So we're going to go back to Yahoo Finance. And again, you can just see AMD here, but we are going to then look at this menu panel. You can learn a ton about the company here, but we want to focus on analysis. Once in analysis, you want to then scroll to the bottom where you're going to see growth estimates. Now you can see AMD has done phenomenally this year. It's actually at 92%, which is incredible. Now we can see what they estimate for next year is actually incredibly high, the next 5 years and the past 5 years. Now, what I would say on the next 5 years, just be careful because some companies have quite bearish analysts where this can be quite low. So either of these numbers is quite a strong indicator. The past 5 years, if the company has passed all your other checks and is likely to be around and continue to grow, the past 5 years is often a very good indicator. Here, I'm very happy with the next 5-year forecast at 38.2%. So this is the number I'm going to drop into the growth rate. So we drop that in here. It does round down to 38, but I'm happy with that. Keeps it a bit conservative. Now, minimum rates of return, as before, mine is 15%. Your margin of safety here, minus 50%. Again, you choose these yourself. Then price earnings ratio, our PE ratio. Now this first one is 2 times the above growth rate, which of course is going to be 76 here. And I'll actually code this so it just does this automatically. But this one of course will be 76 here. But then here, your 5-year average PE ratio. This one we have to find, and it's also very important because the tool needs to use the lowest of these two over here. So let me show you how to find this one. In this case, actually come over to MSN Money. You can see it on screen here. And then we are simply going to search in this quote box for AMD, as I already have done over here. So we can see AMD here, and then you want to click on analysis in the menus over here. Again, a lot you can learn here, but focus on analysis this time. You can see the PE ratio 5-year high and the 5-year low. And what you want to do is add these two numbers together, divide by 2, and that's going to give you an average of these two. And that is going to be your average 5-year PE. So if we do this quickly on screen here, we can see 157.69 plus our other one, which is 54.17, is going to equal 211, and we are going to divide that by 2, and that's going to give us 105.93. That is going to be our average 5-year PE ratio. And so we drop it in here, and the tool does exactly what we just spoke about. It's now calculated all of this. By the way, it has used this time, the 5-year average PE ratio. It actually hasn't used the 76, but I'll program it to use the smaller of the two. Personally, I prefer this one that we use based on the data we find. So if you don't want to use 2 times the growth rate, if that seems a bit obtuse to you, you can also just leave this one blank, and then it's always going to use this. And for those of you wanting to be a little more conservative, you can of course also input or leave the 2 times growth rate there. It will use the smaller of the two. It's calculated now, and you can see our EPS in 10 years will be $12.89 a share, and then we can see our price of the stock in 10 years is likely to be $1365, which I personally don't think is too exaggerated for a company like AMD. I think they could see significant growth over the next 10 years. Also considering companies like Nvidia have much higher prices currently. Now, based on that, if we were to achieve our 15% return every year, then remember it's discounted, so we would need to buy at $316. However, we want a margin of safety on that. We want to buy it below that intrinsic value. That's the real value of AMD today. We want to buy it below this by 50%, which puts us at 158. That's our margin of safety price. We're looking to buy this company for less than that. It's currently at 92, so it would appear to be a really good deal. Now, in this case, it's obviously, well below even our margin of safety. So I definitely want to also use this rate here, 2 times the growth rate. And that's why you can see a lot of angles towards being more conservative in these calculations. So what I'm going to do is quickly just swap these just to see what we come out with, and use the smaller of the two just so you can see how that works. And so here I've just used the smaller of the two. But here we can see we come out to a $9.79 stock price in 10 years. We would have to buy $226 today at the intrinsic real value of this company, and that would allow us to also gain that 15% return. Now here, when we divide by 2, we get to a margin of safety price of 113. The stock's currently at 92, so again, we're below our MOS. And I think even on the conservative side, this shows this company is currently undervalued. And so the big point of this is really that when we work this out, we now have reference to the stock price today, because the stock price is driven by a lot of different factors: what's happening in the world, in politics, just in general human emotions with current situations. So this allows us to look more at statistics and just try conservatively forecast what this is likely to be in the future based on actual facts on sites right now, and then discount it back and work out a reference price. When would be good for us to buy, and then you're able to watch that list of companies you put together and buy them when they do hit your MOS. So this is a really nice shorthand way to do it. I'm going to make this worksheet available for you below in the description of this video, so you can grab it there for free. I'm just going to adjust a couple things to make sure it's perfect, then you can get it there. I am also going to link to a channel which is much more in depth, as I said, which is going to be on discounted cash flows, in which you put a lot more data into the sheets and you can get even more accurate, but you're doing it with discounted cash flows instead of earnings per share. Now, some of you are going to be more confident in using the actual past 5 years. Again, this is just on Yahoo Finance in analysis on AMD. But some of you will be more confident using this number because it's a proven past 5-year performance. Others will choose to use the next 5 years, but this is based on what the analysts are saying. So if we drop this one in, let's see what happens. So we just drop it in here and you can see it's calculated this. And here we're actually getting down to 370. So that's how much a share is worth today based on intrinsic, or the real value of the company, based on the past 5 years growth rate, and that expected to continue in the future. So here we get to 370, and when we half that, our margin of safety is 185.38 per share. That's what we're going to look to buy at. Now, what I want to show you is a tool which is also going to automate this process for you. If you're a bit concerned that you might put the wrong numbers in here, etc., or you just want a second reference point to this calculation that you do, there is a tool that I found really useful. And in fact, this guy's teachings is the basis of what I've covered today. So I definitely want to give him a lot of credit for the content we've gone over here. And I'm also going to link to him below. So this is the Rule 1 Investing Toolbox. Now, Rule 1 Investing is run by a guy called Phil Town. You can also find him on YouTube. I'll link to him below. But this tool is very, very effective in giving us those same numbers without you having to actually do the calculation. The value of this tool is that it does the calculation for you. So if we look at AMD, for example, you can see it right here. I have this on my watch list. And you can see that the current price is $91.55 today. And you can see over here, we have a couple points. We have the margin of safety and we have the sticker price. The sticker price relates to the intrinsic value, the real value, the bigger number we just worked out. The MOS, of course, is half of that, half the real value, or in this case, half the sticker price. So looking at AMD again, you can see here the sticker price is 409, while the margin of safety is half of that at 204. Now, if we compare that to the numbers we just worked out, you can see here that their intrinsic value calculation is actually a bit higher than ours. We came out at 370 here on our highest estimate. They have 409. And then their margin of safety, of course, 204, and ours was 185. But this is going to give me even more confidence on the fact that this company is undervalued. So this is just another tool for those of you who want a shorthand, quick way to do it, or a double reference. I can't recommend this tool enough. Now, the one limitation with this tool is that it's only for US stocks. So you can't run this, for example, for European stocks. But I thought it was definitely worth sharing. And step number 3 is to click the like button. No, step number 3 is actually to compare our MOS to today's stock price. And this part's quite simple. For the companies you're looking at, for example, we're looking at AMD now. Find that on Yahoo Finance. You can see the price it's trading at here. The market's currently closed, but you can see the US market's open in 30 minutes. So here we want to compare this to the numbers we've got to. Now we know our real value or intrinsic value of a share today is 370, but we want to buy it with that margin of safety at 185. So it's well below our 185 target. In fact, it's half of that. So it's almost like a 75% margin of safety here. So here it definitely looks to be undervalued. However, remember on some of yours, the price today might not be below your MOS, and that's why you put together a bigger list of companies. But the key here is that you're vetting all your companies to find those that you can buy at that MOS level. Step number 4 is to evaluate the short-term graph to choose your entry point. And so since AMD looked quite good, let's use them. We're actually just going to pop this chart out to full screen. And then here, I like to look at the past 6 months. You can see if you bought down here, you're doing really well. But we want to see the trend and where things are going. Where's the price been stable in the past, and is it a good time to buy right now? Because remember, you might be below the MOS, that's great, but you don't want to buy it on a spike. You want to buy it at a decent short-term level as well. So if you have trading experience, you can apply technical analysis, but in layman's terms, you're just looking for the general trend. So for example, if I was buying AMD, I'm not going to buy, say it's on this day, I check AMD on the 4th of December 2020. I'm not going to buy today because that is literally the all-time high for AMD. I can see it's been much lower over here. It's not the best decision to buy it when it's at its absolute all-time high. Then you can see it's retraced, which is just a healthy movement of a stock. It's gonna go up, it's gonna consolidate a bit, it might pull back a bit, it's gonna consolidate, it's gonna move up. So you don't want to be buying right on the very, very tippy top. So just do that on your short-term evaluation on it, and that way you can judge a good entry point. So here where you would have bought at 94, if you waited a little bit, you might have bought it here at 89. That might have been your target. Okay, I want to see it, but it was below 90 for ages. It's just bumped over 90. So I'm going to wait for below 90, and you buy it here at 89. So that way you've saved yourself $4 or $5 on that purchase, which might not seem like much, but that's going to add up if you're buying a lot of shares. So that's just the last thing I would say, is learn a bit of technical analysis, or just look at that trend, pick a good moment in the short term. Although this is going to be a good investment long term, don't forego that little change that you might identify here. And step number 5 is to buy. So this is where you're actually going to look to own a piece of that company. Let's say, for example, it was AMD. The way you actually buy these is using a broker. Now, broker is literally just a website where you can buy stocks, and you might have ones that offer European stocks or US stocks or both. Now, for me with value investing, I focus solely on the US stock market and US companies. So you do want US exposure if you're like me in this case. So you need a broker with US exposure that allows you to buy US stocks. And now, although I know there's a lot of apps and phone things and these quick things to buying stocks, etc., and they are great, personally for me, I like to use a computer and a long-standing broker that's been there a long time, very, very trusted. That's what I prefer to do. I also like to use brokers who have a flat fee structure rather than a percentage-based structure. So a flat fee might be you pay $20 every single month and that's it forever, which is quite expensive in the beginning when your account's quite small. You don't have that much there. But when your account's huge in the future, hopefully, then that $20 a month is absolutely nothing. Percentage-based fees often look great because it's this tiny percentage. So it's very cheap in the beginning, but as your account grows over time, that small percentage becomes a significant amount of money. And so for any of you also in the UK, I use Interactive Investor here, and it gives me all those advantages we just spoke of. But wherever you are in the world, you will have a broker available. Just make sure they're a long-standing broker. And so you buy your first company, and then you're going to look to add to that list. You're going to look to add between 5 and 10 companies over time. You're going to hold them for the long term. And that brings us to number 6, which is to hold. As we said in the beginning, if you are not willing to invest in it for 10 years, don't invest in it. The reason for that is the market does this all the time. And bad news comes, stock prices go down. Don't let that move you out of your position. Remember, you have bought this at half its real value. Long term, it's going to go up. So if you buy it and in the next 2 weeks it goes down, do not even think of selling it. In fact, you should be thinking of adding to your position because you're now buying it at even more of its actual value. And that's also a cool strategy. If you're a bit worried, put half your investment in at one time and then the other half a little later. And between those two price points, you're going to average out your buy price of the quantity of those stocks. So don't let the erratic price movements move you out of the market. You've done your due diligence. It's a good long-term position. And just before we go, I wanted to give you a couple that you can look into. One is Micron, MU, as we looked at. You can also look at AMD, also look at Alibaba, which is kind of coming down. And this is another thing with value investing. When it's coming down, everyone's going, oh, don't buy it. It's often when value investors make the most money because they're looking for it to come down to that MOS or below. So that's something else to just keep in the back of your mind as you do this. And then the last one is ATHM, which is Auto Home. Personally, I've loved this approach to investing. I've had a lot of fun with it. You're understanding the company, what it does, and you're becoming kind of an owner of that company and seeing it that way. It makes way more sense to me. But I know this is a bit different, and I do want to hear from you below. Did you enjoy this? Do you want to hear more on this? Do you get excited about it like me? Please let me know in the comments below. And if you did find this valuable, please drop us a quick like. It means a lot to us. Subscribe. Notifications on. As always, I hope you're all doing really well. Happy investing, and I will see you in the next video.